In October 1973, war broke out in the Middle East. Israel was attacked by Egypt and Syria on Yom Kippur, the holiest day in the Jewish calendar. The conflict lasted less than 3 weeks, but its economic consequences would reshape the world for decades. Arab members of OPEC, the Organization of Petroleum Exporting Countries, decided to use oil as a weapon. They announced an embargo against nations supporting Israel, primarily the United States and Western Europe. Oil supplies would be cut. Prices would rise. And the countries that had built their entire economies on cheap, abundant energy would learn what happened when that energy disappeared. Within months, oil prices quadrupled from $3 per barrel to $12. Gas stations ran out of fuel. Motorists waited in lines for hours hoping to fill their tanks before supplies ran out again. In America, the federal government imposed a national speed limit of 55 miles per hour to conserve gasoline. Rationing was discussed. The idea of permanent energy abundance, the assumption that had defined the post-World War II boom, was shattered. But nowhere was the impact more severe than Britain. The oil crisis hit the UK when the country was already in economic distress, and the combination created a national crisis so severe that the government imposed restrictions not seen since World War II. In January 1974, Prime Minister Edward Heath announced that Britain would move to a 3-day week. All businesses except essential services would be limited to 3 consecutive days of operation per week. The reason was simple and terrifying. Coal miners were on strike demanding higher wages. Britain's power stations ran on coal. Without coal, there wasn't enough electricity to power the nation. Combined with the oil crisis reducing available energy even further, the UK faced the choice between total blackouts or rationed electricity. The government chose rationing. For 2 months, from January through March 1974, Britain operated on a 3-day week. Offices were dark and empty 4 days per week. Factories sat idle. Workers were sent home with reduced pay. Television broadcasts ended at 10:30 p.m. to save electricity. Families ate dinner by candlelight because the power was cut. But here's what matters right now in December 2024. Everything that created the 1973 oil crisis and the 3-day week exists today in more dangerous forms. Global energy supplies are tight. OPEC+, the expanded cartel including Russia, is cutting production to maintain high prices. Geopolitical tensions in the Middle East, Ukraine, and Asia threaten supply chains. Europe, having shut down nuclear plants and become dependent on Russian gas before the Ukraine war, is more energy vulnerable than at any time since 1973. And the green energy transition, while real, is nowhere near capable of replacing fossil fuels at scale. The infrastructure doesn't exist. The technology isn't ready. The investment hasn't been made. Based on every pattern from 1973 and every current energy market indicator, we're approaching an energy crisis in 2025 or 2026 that will make the 1970s look mild. The warning signs are flashing. The vulnerabilities are obvious. The geopolitical triggers are in place. And most Western populations, particularly in Europe and Britain, are completely unprepared because they've been raised in an era of energy abundance and told that fossil fuels are being replaced when the data shows they're not. This isn't ancient history for perspective. This is the immediate blueprint for the greatest economic disruption since 2008, and for investors who understand energy markets, the greatest profit opportunity in a generation. The 1973 oil crisis didn't start with the Arab-Israeli War. It started with decades of Western dependence on Middle Eastern oil. After World War II, the US and Europe rebuilt their economies on cheap, abundant petroleum. Cars, suburbs, plastics, chemicals, transportation, heating, everything ran on oil. The price stayed low throughout the 1950s and 1960s, around $2 to $3 per barrel, because supply from the Middle East seemed infinite and the producing countries had limited power to control prices. Western oil companies, the Seven Sisters, dominated the global market and kept prices stable. But through the late 1960s and early 1970s, OPEC members gradually gained more control over their oil resources. They nationalized production. They coordinated policies. And they recognized something crucial. Western economies were completely dependent on their oil. If supplies were cut or prices raised, the West had no alternatives. Not in the short term. Maybe not ever. Oil was heroin, and OPEC controlled the supply. The Yom Kippur War in October 1973 gave Arab OPEC members the political justification to use that power. On October 17, 1973, OPEC announced a 5% production cut and embargoed shipments to countries supporting Israel. This included the United States, Britain, Netherlands, and Japan. The impact was immediate and severe. Oil prices began rising. By December, the price had gone from $3 to $12 per barrel, a 300% increase in 8 weeks. Gas stations across America ran out of fuel. Motorists started panic buying, topping off their tanks whenever possible, which made the shortages worse. Lines at gas stations stretched for blocks. People waited hours to get 10 gallons. Fights broke out. Stations started rationing, allowing customers only a few gallons per visit. President Nixon responded with emergency measures. The national speed limit was reduced to 55 miles per hour because slower speeds improved fuel efficiency. Daylight saving time was extended year-round to reduce evening energy consumption. Nixon urged Americans to lower their thermostats and reduce holiday lighting. Gas rationing was proposed but never fully implemented. The crisis created a psychological shift in American consciousness. The abundance and optimism of the 1960s gave way to fears of limits and decline. The idea that America was invincible and prosperity was guaranteed began to crack. But the impact on Britain was far worse because the oil crisis hit when the UK was already in economic crisis. Britain in the early 1970s was known as the sick man of Europe. Growth was stagnant. Inflation was rising. Industrial relations were collapsing as unions and government fought over wages and working conditions. The oil crisis was the final blow. Britain, heavily dependent on imported oil, faced soaring energy costs at exactly the moment when it could least afford them. And then the coal miners went on strike. The National Union of Mine Workers, one of Britain's most powerful unions, demanded wage increases to match inflation. The Heath government, trying to control inflation through wage restraint, refused. In November 1973, the miners began an overtime ban. Coal production fell. Power stations, which generated most of Britain's electricity from coal, started running low on fuel. Combined with the oil embargo reducing available petroleum for backup generation, Britain faced an energy catastrophe. Electricity supplies were insufficient to meet normal demand. Rolling blackouts began. The government had to choose between allowing total grid collapse or imposing strict rationing. In December 1973, the government announced emergency measures. A state of emergency was declared. Television broadcasts would end at 10:30 p.m. Street lighting would be reduced. And most dramatically, industry would be limited to a 3-day working week. The 3-day week began on January 1, 1974, and lasted until March 7. For 2 months, most British businesses could operate only 3 consecutive days per week. The specific days were assigned to avoid everyone operating simultaneously and overloading the grid. Workers were sent home for 4 days per week with partial pay. Factories sat dark and idle. Office buildings were empty. The economic impact was devastating. Production fell. Companies laid off workers or reduced hours. Workers' incomes dropped. Consumer spending collapsed. Unemployment rose. Britain's GDP contracted. But the psychological impact was even worse than the economic numbers suggested. The 3-day week was a national humiliation. Britain, which had won World War II and built a welfare state, which considered itself a first-world developed nation, was operating on wartime-level restrictions in peacetime. Families eating dinner by candlelight because the power was out. TV going dark at 10:30 p.m. Streets unlit at night. It felt like the end of British power and prosperity. And in many ways, it was. The political consequences were immediate and profound. Prime Minister Edward Heath called a general election in February 1974, asking voters who governs Britain, the government or the unions. He lost. Labour won a narrow victory, and Harold Wilson returned as Prime Minister. But Labour couldn't solve the underlying problems either. The miners got their wage increase. The 3-day week ended. But the energy crisis continued. Oil prices stayed high. Inflation accelerated. By 1976, Britain would be forced to go to the International Monetary Fund for a bailout, a humiliation normally reserved for developing nations. The 1970s became synonymous with British decline. The 3-day week. Inflation reaching 25%. IMF bailout. The winter of discontent in 1978–79 when strikes paralyzed the country again. It took Margaret Thatcher's election in 1979 and her brutal economic reforms to finally break the cycle, but at enormous social cost. The 1973 oil crisis didn't cause all of Britain's problems, but it exposed and accelerated them. It revealed how fragile the entire economic model was. How dependent on cheap energy. How vulnerable to external shocks. Now here's where 1973 becomes the blueprint for 2025 and 2026. Every element that created the oil crisis exists today in more extreme forms. In 1973, Western economies were dependent on Middle Eastern oil with no alternatives. In 2024, Europe is dependent on fossil fuels with alternatives that don't work at scale yet. In 1973, OPEC used supply cuts as a weapon. In 2024, OPEC Plus including Russia is cutting production to maintain prices above $80 per barrel. In 1973, geopolitical conflicts threatened supplies. In 2024, Ukraine war, Middle East tensions, and China-Taiwan risks threaten global energy. In 1973, Britain faced simultaneous oil crisis and domestic labor disputes. In 2024, Britain and Europe face energy vulnerability, inflation, and social unrest. In 1973, governments assumed energy supplies would always be available. In 2024, governments assume the green transition will happen fast enough to replace fossil fuels. Both assumptions are catastrophically wrong. The difference is that today's energy crisis will hit harder and faster because the global economy is larger, more interconnected, and more dependent on energy-intensive activities than in 1973. The data showing current energy vulnerability should alarm anyone paying attention. Europe's energy crisis in 2022 to 2023, triggered by Russia cutting gas supplies after the Ukraine invasion, showed how fragile the system is. Natural gas prices in Europe spiked over 10 times normal levels. Industrial production was cut. Government spent hundreds of billions on subsidies to keep the lights on. Germany, Europe's industrial powerhouse, came close to rationing energy to factories. The crisis has eased somewhat as Europe found alternative supplies and reduced consumption, but the fundamental vulnerability remains. Europe shut down nuclear plants for political reasons and became dependent on Russian gas. Now Russia is an enemy and the gas is gone. Britain specifically is more energy vulnerable than most realize. North Sea oil and gas production has been declining for decades. Britain went from energy self-sufficient in the 1980s and 1990s to a net importer. The UK closed coal plants for environmental reasons without building enough nuclear to replace them. Wind and solar provide some electricity but are intermittent and can't meet demand during low-wind cold winter days when energy demand peaks. Britain now imports electricity from Europe through undersea cables, which means British energy security depends on European energy security, which is fragile. Global oil supplies are tighter than they appear. OPEC Plus has been cutting production throughout 2023 and 2024 to keep prices between $70 and $90 per barrel. Saudi Arabia and Russia, the two dominant players, are maintaining cuts because they need high prices to fund their governments. U.S. shale production, which boomed in the 2010s and reduced American dependence on imports, has plateaued. Shale companies are focusing on profits and returns to shareholders rather than production growth. Investment in new oil projects has fallen dramatically since 2020 as banks and investors reduce fossil fuel exposure under ESG pressure. At the same time, demand is still growing. China and India, with billions of people industrializing, need more energy every year. Electric vehicles are growing but still represent a tiny fraction of the global vehicle fleet, and the electricity to charge them has to come from somewhere, usually fossil fuel plants. Aviation, shipping, manufacturing, chemicals, plastics, all still run on oil and gas with no viable alternatives at scale. The idea that renewable energy will replace fossil fuels in the next 5 to 10 years is fantasy. The infrastructure doesn't exist. The investment hasn't been made. The technology for storage and grid stability isn't ready. This creates the setup for a crisis that mirrors 1973 but worse. Tight supplies. Geopolitical instability threatening major producers. No spare capacity. Economies totally dependent on energy with no alternatives ready. All it takes is one shock. An attack on Saudi facilities like the 2019 drone strikes that temporarily knocked out half their production. Israel-Iran conflict escalating to target oil infrastructure. China-Taiwan war threatening Asian supply routes. Domestic unrest in a major producer. Any of these could trigger supply disruptions that send prices soaring past $150 per barrel or higher. When that happens, the response will make 1973 look orderly. In 1973, energy markets moved slowly because everything was manual. Today, algorithmic trading and financialized commodity markets mean prices can spike 30 or 40% in days. In 1973, rationing took months to implement. Today, governments could impose emergency measures in weeks. In 1973, social media didn't exist to amplify panic. Today, one viral video of empty gas stations or blackouts would create runs that make the supply situation worse. Europe will be hit first and hardest because they're most vulnerable. If Russia further cuts remaining gas supplies, or if Middle East tensions interrupt LNG imports, or if a cold winter creates peak demand, Europe faces the choice between blackouts or rationing. Industrial production would be cut first. Germany's chemical and auto industries use enormous energy. Cutting their power means shutting factories and laying off workers. Then comes residential rationing, rolling blackouts, restrictions on heating and electricity use. The 3-day week could return to Britain and spread across Europe. The economic impact would cascade globally. Europe is a huge market. If European consumers can't afford energy or if production is cut, global trade contracts. Supply chains break. Inflation that has already been stubbornly high would spike further. Central banks face an impossible choice. Raise rates to fight inflation and crash the economy harder, or keep rates low and let inflation run. There's no good answer. It's called stagflation. Stagnant growth plus inflation. The 1970s disease that destroyed economies and governments. And it's coming back. So what do you do? How do you position before the energy crisis hits? Step 1 is understanding that energy stocks and commodities offer the most direct protection and profit opportunity. When oil prices go from $80 to $150 per barrel, oil company profits and stock prices multiply. In the 1970s, oil companies made record profits while the rest of the economy suffered. The same will happen again. The Magnificent 7 tech stocks that dominated returns for the past decade won't save you during an energy crisis. But energy companies will perform regardless of broader market conditions. Step 2 is identifying which energy companies are best positioned. You want producers with low debt, low production costs, and reserves in stable jurisdictions. U.S. shale producers like ExxonMobil and Chevron benefit from high oil prices while producing in a safe country. European integrated companies like Shell and BP have global diversification. Canadian oil sands producers like Canadian Natural Resources have reserves measured in decades. Avoid highly leveraged producers that need high prices just to service debt. In an energy crisis, the strong companies print money. The weak companies survive or fail based on whether they can refinance debt at higher rates. Step 3 is recognizing that energy infrastructure and services also benefit. Pipeline companies that transport oil and gas. Refining companies that process crude into products. Oil field services companies that drill wells and maintain production. Tanker companies that ship oil globally. These businesses profit from high energy prices and increased activity even if they don't produce oil themselves. And many pay high dividends, providing income while you wait for the crisis. Step 4 is considering commodities directly rather than just stocks. Oil futures, if you have access through your broker, provide pure exposure to price moves. When oil goes from $80 to $150, oil futures double. But futures are leveraged and risky, requiring active management and stomach for volatility. For most investors, commodity ETFs that hold oil futures or baskets of energy stocks provide safer exposure. Funds like USO for oil or XLE for energy stocks let you participate without the complexity of futures contracts. Step 5 is understanding that energy crisis benefits more than just energy companies. Defense contractors benefit because energy crises often accompany or cause geopolitical conflicts. Agricultural commodity producers benefit because food production depends on energy-intensive fertilizers and transportation. Gold and other hard assets benefit as inflation accelerates and currency purchasing power falls. Your positioning shouldn't be only energy stocks. It should be a portfolio that performs during stagflation, which means inflation-resistant assets across multiple sectors. Here are the specific warning signals that will tell you the 1973 playbook is accelerating toward crisis. Signal 1 is oil inventory levels. The U.S. Energy Information Administration publishes weekly data on crude oil and gasoline inventories. When inventories fall to 5-year lows or below, supplies are tight and any disruption will spike prices. In 1973, inventories were low before the embargo, which made the impact more severe. Right now in late 2024, inventories are moderate but declining. Watch this weekly. When inventories hit multi-year lows, the crisis is approaching. Signal 2 is OPEC Plus production cuts extending or deepening. Saudi Arabia and Russia announce production plans monthly. When they extend cuts past current commitments or announce deeper cuts, they're signaling they want even higher prices and supplies will get tighter. In late 2024, OPEC Plus has maintained cuts but not deepened them. If they announce further cuts in early 2025, especially if oil is already above $90, it means they see demand supporting even higher prices. That's your warning. Supplies are about to become critically tight. Signal 3 is geopolitical tension escalation in major producing regions. Middle East conflict between Israel and Iran or proxies. Attacks on Saudi facilities. Strikes or unrest in Venezuela or Nigeria. Tensions between US and Venezuela over sanctions. Any of these can remove production from markets immediately. Follow geopolitical news specifically focused on oil-producing regions. When tensions escalate or attacks occur, position immediately because prices will spike before most investors react. Signal 4 is European energy emergency measures. The UK and European governments announced energy emergency plans in 2022 during the Russia gas crisis. If they dust off those plans or announce new rationing measures, it means they see the crisis approaching. Governments don't announce rationing unless they believe it may be necessary. These announcements often come weeks or months before rationing is actually implemented. That's your window to position before the crisis goes mainstream. Signal 5 is crack spreads widening. This is technical but important. The crack spread is the difference between crude oil prices and refined product prices like gasoline and diesel. When crack spreads widen dramatically, it means refining margins are increasing, which happens when product demand exceeds refining capacity. This signals the energy system is under stress. Refinery capacity is limited. If crack spreads widen to historically high levels, refineries can't meet demand, which means shortages are coming. Bloomberg tracks this data. When spreads exceed historical norms by 50% or more, it's a warning signal. Your 90-day action plan starting right now must prioritize energy exposure in your portfolio. In January 2025, audit your holdings and calculate your energy sector allocation. Most investors have zero or minimal energy exposure because tech stocks have dominated returns and ESG funds exclude fossil fuels. You need at least 15 to 20% energy exposure to benefit from the coming crisis. Begin building positions in large-cap oil producers like ExxonMobil, Chevron, Shell. These are liquid, pay dividends, and will perform when oil prices rise. In February 2025, expand to energy infrastructure and services. Pipeline companies like Enterprise Products Partners and Energy Transfer. Oilfield services like Schlumberger and Halliburton. Refining companies like Valero and Phillips 66. These provide diversification beyond pure producers and benefit from high energy prices in different ways. Build positions gradually over weeks, not in single large purchases. You want average cost positions rather than trying to time exact entries. In March 2025, set up monitoring for the 5 warning signals. Create a simple tracking system that updates weekly with oil inventories, OPEC announcements, geopolitical events, European energy news, and crack spread data. This doesn't require sophisticated tools. Free data from EIA, news alerts for OPEC, and basic Bloomberg or financial websites. Color code your tracking so you can see at a glance when multiple signals are flashing red. When 3 or more signals are activated, move to maximum energy allocation. From April through June 2025, maintain your positions and continue monitoring. Energy stocks may underperform tech during this period if the crisis hasn't materialized yet. Don't panic sell. You're not positioned for the next 3 months. You're positioned for the crisis that could hit in the second half of 2025 or 2026. The temptation will be strong to chase whatever is working short term. Resist it. Your energy positions are insurance that pays when the crisis hits. From July through December 2025, this is when the crisis most likely arrives based on historical patterns and current trajectories. Summer is peak driving season when gasoline demand is highest. Winter is peak heating season when natural gas and electricity demand peaks. If there's going to be a supply shock or geopolitical trigger, it typically happens during these high demand periods. When the crisis hits, when oil spikes past $120 or $150, your energy positions will multiply while the rest of the market struggles. The parallels between 1973 and today aren't subtle. In 1973, Western economies were completely dependent on Middle Eastern oil with no alternatives. In 2024, Europe is dependent on fossil fuels with alternatives that don't work at scale. In 1973, OPEC used supply cuts to achieve political and economic goals. In 2024, OPEC Plus is cutting supply to maintain high prices. In 1973, governments assumed energy would always be available and cheap. In 2024, governments assume the green transition will replace fossil fuels soon. Both assumptions were catastrophically wrong. In 1973, when the crisis hit, it caught populations and governments completely unprepared. Gas lines formed overnight. Rationing was implemented in panic. Economic growth turned negative. Inflation accelerated. Governments fell. In 2024, when the next energy crisis hits, it will catch Western populations even more unprepared because they've been told fossil fuels are being phased out and renewables will replace them. The reality is fossil fuels still provide 80% of global energy and renewables can't replace them for decades at minimum. The three-day week wasn't just an economic crisis for Britain. It was a psychological crisis that revealed how fragile the entire system was. How close to the edge? How dependent on resources that could be cut off? Britain in 1974 was a first world country operating under third world conditions. Blackouts. Rationing. Reduced working hours. It shattered the assumption that developed nations were immune to that kind of collapse. Today's Britain and Europe are even more vulnerable because energy infrastructure has been underinvested for 2 decades while demand has grown. The 1973 oil crisis eventually ended. OPEC lifted the embargo in March 1974. But oil prices never returned to pre-crisis levels. $3 oil was gone forever. The cheap energy era that powered post-war prosperity was over. The 1970s stagflation that followed, inflation plus recession, persisted until Paul Volcker's brutal interest rate hikes in the early 1980s finally broke inflation at the cost of a severe recession. The same pattern is setting up today. Energy prices won't return to 2020 levels. The era of cheap abundant energy is ending. Stagflation is returning. And the political and social consequences will reshape Western societies. But for investors who understand what's coming and position appropriately, the 1973 oil crisis offers a clear playbook. Energy companies and commodities multiplied in value during the 1970s while the broader market struggled. Oil stocks were the only consistent winners for a decade. The same opportunity is approaching. The warning signals are flashing. The vulnerabilities are obvious. The geopolitical triggers are in place. The question is whether you'll position before the crisis or learn about it when gas stations are empty and your heating bill has tripled. If this gave you the exact playbook to position before the 2025 energy crisis that will mirror the 1973 oil shock and Britain's 3-day week, hit subscribe. The age of cheap abundant energy is ending. The question isn't whether there will be another energy crisis. The question is whether you'll profit from it or be destroyed by it. History doesn't repeat, but if you ignore it, you will pay the price. The 3-day week is coming back. The question is whether you'll be ready.